Okay.
I will tell you this right now. It's gone up to $5,000 per door.
Currently.
If you do everything, and everything is, number one, you make it energy efficient, but then also you make it solar ready. And you might go, oh, solar ready, what do I have to do? You know what you have to do? You have to put conduit from the roof.
Hello, you're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I am your host, Mr. Brandon Elliott, and today you are in for a doozy. I'm really excited for this one. As you start making money, start investing in real estate, you're going to have many different ways to benefit from real estate. Of course, you'll get crazy cash flow and then taxes come around, right? You want to make sure that you start protecting yourself. You start being able to write off as much as you can legally and ethically, and make sure that you're preparing yourself to be able to constantly keep growing, right? There's certain phases of growing and then paying things off and so forth throughout the journey. And cost segregation, we have talked about in the past. I think today we're going to dive a little bit deeper into that, but something that is very special and something new that you most likely have just simply not heard of yet, right? Until today. This is going to be an awesome episode. We're going to be talking about energy tax credit. It just came out in September. So very fresh, very new. And Joe is with us today that he's going to be able to deep dive into exactly what this is, how it can best serve you and benefit you and your family. And what's really cool is that he's in our backyard. If we would have known about this, we would have been bumping knuckles right next to each other, but he is in San Diego. So Joe, what's going on, my friend? How are you today?
Well, I'm excited to be here. I love it when I have something new because cost segregation has been around. Some people say, in my world, it's been around since like 2000, 2007, but it's a lot of people think it goes back for years and years and years. I'm not going to go down that road, but now we have something new, which is really coming up to mind consciousness is the energy tax credits. Yeah.
And I think this is cool because I didn't even know about cost segregation. I heard about it a couple of years ago. I didn't realize the benefits and how important it truly was until I had my accountant say like, hey, you should really consider this. And then I started looking into it deeper, refreshed it, and I was like, yes. So this past year, just off of a few properties, I'm personally going to write off a little over $1 million on my taxes, which I'm just like, finally, thank God. But talk to me, this new energy tax credit, like what the heck is this? How can this benefit the listeners? But before we even get into that, for anybody out there that doesn't know exactly who you are, where you're from, what you're up to, do you mind just giving that 30,000 foot view of your company and how you best serve people?
Yes, great. So my background is I've always been an entrepreneur. Before the year 2000, I actually worked in a self-interest travel company, special interest travel.
Nice.
And so then in 2000, I segued, I sold the business and I got involved with the California Association of Realtors. Yep. And then as we're marching down to 2007, I had a buddy who kept wanting to tell me about something. And I blew him off because I thought he wanted me to join Amway and sell soap. Finally, I said, okay, Mike, let's go to lunch. And he told me about it. And he told me about a strategy out there that was impacted income taxes. And I had a couple of clients that had income tax problems and they needed help. So I got them involved and I helped them save $50,000 each, both of these clients. So they were all excited. And then the car went off the cliff in 2008 and my career with the California Association of Realtors went with the car going over the cliff. So the engineering company that I placed those two orders with called me and said, why don't you come and work for us? You're really good at this. You understand it. And I segued in and I have never looked back. My business has gone straight up because back in 2007, 8, 9, 10, 11, 12, I just maybe lucky, maybe God, I don't know what it was, but my clients were those that had a lot of cash in their pockets. So everybody was selling and desperate. What were they doing? They were buying. Buying, or they were refinancing and hoping that they couldn't make their loans. And a lot of them did. So then they got to get the property too. So my clients were paying a lot of income taxes. So I started off, Steve, incline, and I've not stopped.
Yeah, I love that.
Yeah.
So, and who you work with typically is a lot of high net individuals here in San Diego and other areas, I'm sure.
Yeah, well, you know what? I got lucky. I started off with one of the, if not the largest in San Diego by, again, luck, God, maybe my talent, I don't know. And they own billions of dollars of real estate. And then through them, I've met other companies that own billions of dollars of real estate. However, in the recent history, like 6-7 years ago, we developed another technique that opened the door for those that own smaller properties. Because what we couldn't do before is we would have to go to the property and measure everything and document it. Well, obviously, if I'm going to get on a plane, train, automobile, bus and go X to wherever for a property, it's going to cost money. So those fees were thousands of dollars. But for somebody who owned a single family home, well, they couldn't spend thousands of dollars. It didn't make sense. So we've developed an analytical approach, and that has opened the door to all these investors who own either small commercial buildings or single family homes that have a building basis of 700,000 or less. And we're one of the only ones that do this type of study. And we do a great job, and we're very well known for doing the modeling study, which is analytical.
I love that. When you say 700,000 or less, is that the value of the property you're saying?
No, nothing is value. What happens in my world, it's what you paid for the building. So if you bought a building for, I'll make up a number, $1.2 million, and you, not me, because we're not land valuation experts, but somebody values the land and says 200,000 is the land. Now you have $1 million building basis. That is what we work with, the $1 million building basis, not the $200,000 land. So when I'm talking numbers, when I say 700,000, you probably bought the property for 800,000 and 100,000 is land or whatever you allocate to land. But I'm talking about the building basis.
Okay. And are you helping people in just San Diego, or is this nationwide?
No, we're nationwide. We're everywhere. Every state in the union, I've done a project.
Let's go. I love it. Okay, now talk to me about this new thing that we have out there. It just announced in September. It's an energy tax credit. Is there a certain name to it? Break it down for us.
Yeah. Okay, it's called the 45L. And let me tell you what's going on in cost segregation to set the table. There are I've been doing this for a while. I came up with 3 circumstances where one should not do cost seg. One would be now this is going to be very tough to people to understand. If you're not paying any income taxes, do not call Joe.
Yeah, don't do that. Yeah.
Don't do that. You think I'm being sarcastic, but I'm not, because real estate provides a lot of deductions. So I have a lot of wealthy investors that simply don't pay income tax.
Cook their books, man. No, but
whatever they do, I don't know, because I don't care.
Yeah. But honestly, it's like if you have a good accountant and everything is written off properly and you're doing it, and everything's good and you're not paying any taxes, then there's no need to do a cost segregation.
No need. I don't want your money. I won't take your money. Even if it might look good, I don't want to look good. I just want to help people.
Yeah.
So that's number one.
The reason why I started using it is because I was tired of paying $500,000 or more in taxes every year. And I was like, hey, enough is enough. I need some of this.
Oh, man. Can you imagine at the end of the year having an extra $500,000 in your bank account?
Oh, my God.
Instead of writing a check to the IRS?
Yes. I'm so excited. I can't wait.
Phenomenal. I mean, and even the small single family home, now they've got an extra, $10,000 in the bank.
Yeah.
I mean, I'm happy for them.
Yeah, rightfully so.
Now, number 2 is passive investors. May not make cost segregation work. It's not my decision. It's their accountant's decision. But if you're a passive investor, and by the way, I have a lot of passive investors who do cost seg, but there are limitations. And you would have to talk to your accountant to say, okay, Joe's going to give me $100,000 in deductions. I'm a passive investor. Can I use them? He may say no. And I won't argue with whatever the decision is. So that's another reason why. And here's the third one, which ties into the energy studies, is that if you are not planning on holding the building for at least 1.5 to 2 years. Now, I've segued down from 5 years. A lot of people out there say 5 years, 5 years, 5 years. But I speak all over the country, and I'm on panels with CFOs. And I always ask my CFOs who own, portfolios of real estate, okay, what do you think? And we've kind of distilled it down to about a 1.5 to 2 year hold. It's lower than a lot of accountants think. And I can explain why I believe 1.5 to 2 years is the threshold. I really don't care. If you want to think it's 5 years, fine, don't care. So if you're a flipper, guess what? Don't do cost seg, right? So I couldn't help flippers for all this time.
Yeah.
But guess what happened? The news is in September with the Inflation Act, they cleared up, crystallized the energy tax credits. When you're talking about cost segregation, you're talking about deductions. When you're talking about a tax credit, that's different. That is money. If I give you a $2,000 tax credit, if you owe $50,000 in taxes, now you owe 48. It's not a deduction. It's a take it off the top line. So they're like gold. Everybody wants tax credits. They're very valuable. So
you don't want to leave money on the table. I mean, it's a common sense, right?
Right. And here's where I'll focus right to the target. The target are value add investors. For my client base, I have a lot of value add investors. Yeah. What do I mean?
Yep.
They all go out there and they put those little signs on the telephone poles that say, "We buy your house for cash for so cheap, cheap, cheap." And what do? They find ugly houses. And what do they do with them?
Yeah, they value add. They
fix them up.
Appreciation. Yep.
So if you fix it up, guess what you're going to improve when you fix up the house? The energy. You're going to reduce the energy consumption because everything today, let's say a house was built in 2000 and now you buy it and you fix it up. Built in 2000, you're renovating it today. You really cannot find supplies out there that are not tax efficient. So maybe you could go somewhere really unusual and buy a very cheap air conditioner. But most of the time, your contractors can't buy those because, like in California, they just won't allow them to be sold.
Yep.
So
it makes it a hell of a lot more difficult, to say the least. Yeah.
Everything you put in that house, I can almost guarantee is going to be energy efficient.
Yeah.
Now, what am I talking about? Well, number one, the biggest low-hanging fruit is the HVAC system. Mm-hmm. So I will tell you this, if you replace the HVAC system, then right there alone, you're probably going to qualify, pretty close to qualifying. Sure. But it's a whole mixture of items. So we've got the HVAC, of course, we've got the doors, we've got windows, we've got roofing, insulation, we've got appliances, we've got fixed lighting fixtures, LED versus, your old incandescent lights, water heaters. So we have a whole variety, but what we're trying to do in the initial stage, and by the way, we don't charge either in cost segregation or in the energy studies. We will look at what you did and we will tell you whether we think you're going to qualify or not. So you don't have to pay us for that.
Yeah, you guys do a free estimate up front to see if it's even worth it, because there's an investment to do this. It's very affordable and reasonable, and it makes sense in 90% of cases if you're going to save this much and you have to pay this much to get that. Yep. It's a no-brainer. And
I want the value proposition to be strong. I want somebody who pays me $1. I want to know that they're going to get back $10 minimum.
Yep. Yeah.
So I'm all about value proposition. But here's the wrinkle with the energy tax credits. Okay, well, there's a little segue here. So what happened in September is that they have new rules coming out in 23 and going forward for 10 years.
Okay.
So now we've got the look back studies. That's in 20, 21, and 22. You can go back 3 years and you can claim those tax credits. And if you claim the tax credits going back those 3 years, it's a $2,000 per door tax credit. Well, what's
$2,000 just flat, plain and simple for each door?
For each door. So if you own a 10-unit apartment complex, you're going to get $20,000 in tax credits.
Okay.
If you own $100,000, you're going to get $200,000 in tax credits. And so bottom line is what my engineer does is we model it and we test it against the IRS standards to allow you to qualify for those tax credits. There's a threshold that I believe goes back to 2005 or 2007. So you have to be over that threshold. So is it complicated? It's complicated for the novice who is not the engineer, but it's pretty easy for us to determine whether we can give you a certificate stating that you've increased your efficiency by over 50% over that threshold. And it's not all that difficult.
Okay, so the cost segregations, like you mentioned, there's three people that really it doesn't make sense for, but who it really makes sense for is the active real estate investor that is doing the value add and keeping it for more than 2, 3, 4 years, right?
Yep.
The longer you keep it, like for projects, we do the BRRRR strategy, which is buy, renovate, rent, refinance, repeat. So we have little to no money into our deals, but we do that forced appreciation. And then we keep it for the long run. So that's like perfect for that strategy.
Yep.
Now you're saying basically it's $2,000 a door flat, and you can go back several years on all the properties that you have. So if we have
no, stop there. Not that you have properties that you did the energy work to.
Sure. Okay.
No, so in other words, you could have sold the property 3 years ago.
Oh, wow.
Yeah. Oh, wow. You could have sold it as long as you can tell us what you did to make it energy ready. I need to know, okay, what kind of HVAC did you put in? What kind of doors did you put in? What kind of windows did you put in? What kind of insulation did you put in? But if you did the work, and obviously you're going to have invoices from somebody I bought it at Home Depot. I paid this guy to install it. So you can go back 3 years and you can claim those tax credits even if you sold the property.
Okay. So now we got fix and flip that we're bringing into the mix too. So say I have 30 properties that I buy and hold, and I'm sticking to those 2,000 for each one. That's 60,000, right? And then on top of that, I've done 100 flips over the last 3 years. Now I can get $2,000 for each one of those as well. So now we're adding up all this. I mean, wow, this is incredible. Okay, so you mentioned in 2023 now there's a new portion of this credit that's coming out.
Yes.
When is that going to be released?
Well, it's released. Like? It's effective January 1st. But anything IRS and Congress gets involved in is never a bright line and easy.
Yeah.
So they've been trying to figure out what the heck this is all about. They're dribbling it out enough that we know what's going on. Okay. I will tell you this right now. It's gone up to $5,000 per door.
Currently.
If you do everything, and everything is, number one, you make it energy efficient, but then also you make it solar ready. And you might go, oh, solar ready, what do I have to do? You know what you have to do? You have to put conduit from the roof down to where the panel is. You have to make sure your roof has enough space for the solar panels.
Yeah.
If you do those two things, you're solar ready. You don't have to put solar in.
I like this. That's
like
Joe.
A $500 value add. You put $500 of conduit in to wherever you think the
panels will go.
Yeah. And you're solar ready, and that bumps you up to $5,000 per door. Woo!
My God. Okay.
Now here's one thing too. I should tell you that energy tax credits have been around for a while, but the problem was they only had a year span, and then Congress had to renew them, and sometimes it took 8 months for them to renew it. So nobody wanted to do it. They're not going to do it not knowing if Congress is going to move forward. So everybody just kind of blew it off, said, no, this is too much brain. I'm not going to worry about this and have Congress come back and say, nah, we're not going to do it. And so forget about it. So some people did it, but it wasn't big. Now it's in the law for the next 10 years. So there's no renewing it. It's in there. And bottom line, the look back studies go back for 3 years, 2,000 per door. And then you would have to go back. Unlike cost segregation, you would have to go back and you would have to file a return telling the IRS that you wanted the money for the tax credits. So you would have to use the bad word, which we don't use in cost seg, amended tax return. But it's not a very significant amendment. Yes, you are amending your tax return, but because they're for tax credits, it's not going to cause any issues with the IRS. It's going to be pretty mainstream.
So say if you don't want to actually amend the taxes, you can still can you take advantage of properties that you have in your portfolio for the last couple of years and just not the ones that you've done the fix and flips with?
Here's the deal. I would get an estimate from U.S. Tax Advisors Group. And then what I would do is I'd go to your accountant and you ask them that question. Say, hey, Joe said that you can go back 3 years. Okay, Mr. or Mrs. Accountant, what's this involved? Because I'm not an accountant and I don't know what they would say. You know, they may say, hey, easy peasy, move forward, have them do the certificates and I'll get you the money. They may say, you know what, I don't know, this might not be worth it because, There are an amended tax return because when I deal in cost seg, we don't do any amendments. It's a grandfathered in technique, but the energy tax credits going back. So the ones that don't require the amendment is of course anything you did in 22 or 23.
Yeah. Okay.
Yeah.
That makes sense. Okay. So, do you have to show proof of these things, or it's basically just if an audit comes up, then to get that certificate? Okay.
We give you a certificate, and then the accountant or, CPA, whatever you want to call them, enrolled agent, will do the tax filing. They have their certificates only if ever the IRS asks for them. So they would just do the normal tax filing with the certificates, knowing, again, if their look back studies, $2,000 per door, $5,000 going forward.
Okay. Now, to get those certificates from your company, what is the investment for that typically?
You know what? It's kind of a moving target. How we do both the energy studies and cost seg is by time, of course. But I can give you a parameter. We're talking approximately $475 per energy tax credit certificate. Okay. $475 per certificate. Okay. And what we have to do is we have to get all the information, and then we have to test the information you give us to make sure that the building is going to qualify to meet that threshold. And with cost segregation also is we defend our work. If the IRS has a question, hey, how did you compute the energy tax savings? Well, we've got that all. We'll show them, here's how we computed it, and we defend our work. Same thing with cost segregation, we defend our work.
Yeah, that's good. Okay, so $475 for a certificate that's going to save you minimum at least $2,000 per door versus up to $5,000, which that's a pretty good ROI. I like that.
Yeah.
Okay. What other things does somebody need to know about the energy tax credit, and anything else that we can look forward to in the near future? I know that this one is sticking around for the next 10 years, which is amazing, in comparison to in the past, it was all up and down. But anything else that we're missing here or something to look forward to?
Well, the one issue is this. If you're a value add, even if you're not going to do the energy tax credits, I think it costs so little to make a house solar ready that I think that you should just plan on that. All you value add, call and talk to my energy engineer and just talk to him about what you need to do, the minimum you need to do. Even if you're not going to do the energy tax credits for whatever reason, I don't care. When you're doing the improvements, just make it ready. And if you use it, you use it. If you don't, it's still going to be valuable to the person buying your building to say, oh, my building's, solar ready if you decide you ever want solar.
Yeah.
So I would say keep that in forefront. And we're happy to talk to people and let them know what they need to be thinking about when they're doing value add. The thing is, you may want to talk to my engineer just to make sure that when you're doing the value add, like what is the minimum HVAC system that will qualify? I will tell you now, not being the energy engineer, but it's a 14 SEER.
Okay.
If you go lower than 14, I would say we'd have to dig deeper because that's pretty much the minimum. But 14 SEER is pretty much what everybody's putting in anyway. But so just as long as 14 SEER or greater, and then you want to put in electric water heaters, not gas anymore.
Yep.
Because that's the ones that qualify for the energy. And then everything else, I think if you just buy wherever you buy your construction equipment, is all going to be ready to go. All your light fixtures are all going to be, because no one's putting in incandescent anymore. They're all putting in LED.
Yeah, and that's been forever now. So that's great. So talk to me. Do you guys give a contractor or recommendation on that if needed for somebody to put up? I know it's not really needed because you're working with investors.
We don't charge for that. It's our service to the community. You call us up, we'll tell you what you need to do, what you need to be thinking about. Now, we're not going to go deep into the weeds, but we're going to give you enough information so you can connect all the dots and go, okay, I get it. This is what I need to do.
Yeah, cool. Okay, great. I love it.
Now, there's one other thing I'll mention, although I'm really bad at this because my competitors in the cost seg would probably kill me for saying this, but I'll just tell you my belief system. Don't forget, I've been doing this since 2007. And for the first 12 years, we didn't have 100% bonus depreciation.
Yeah.
It means nothing to me. I think 100% bonus is a great thing to have. But to me, we didn't have it before. So why is it so important? Well, it's nice because what 100% bonus means is you get 100% of all of the components of the building that have a 20-year or less life. So let's just use an example of I'm making it up. 25% I'm going to find in 15 and 5 and 7 year, 25%. Okay, so bottom line is that 25%
The 100% bonus.
Oh yeah, I'm sorry. So you get all of that. You get all 25,000 of a $100,000 house. You get all $25,000. That's complete write-off in
Sure.
tax year 22.
Yep.
However, in 23, it goes from 100 to 80.
Yep.
And then it keeps going down 80, 60, 40, 20, gone. No bonus. But it doesn't make that much difference because you're still going to get the value. It's just that if you don't have bonus, you're going to get it over time. So what does that mean? So if I give you $25,000 now, maybe next year at 80%, you're going to get $23,000. In the next other $2,000, you're going to get in a couple of years.
Sure.
So is it a big factor? I don't think so. But a lot of my competitors are out there saying, you got to do it because this is the last year of 100% bonus. And I shake my head going like, so?
Yeah, I mean, there's benefits to it for sure.
Yes,
anybody that's listening right now, it's, the 100% is gone. That was back in 2022. So if you haven't already done that, then you missed out on that. However, take advantage of it this year if you can, and if it makes sense for you. And we'll tell you how to plug in with Joe in just a moment. But if it does make sense for you, then this year, taking advantage of it and doing it, you'll be able to get 80% of that total amount to be able to write off, which is great. It really adds up. Like I mentioned, I was able to take advantage of it on just a few of my properties just last year. I think it was like 3 or 4 properties. And I'm going to have this year on my tax returns for 2022 filing in just a few weeks. Like I'm going to have a little over $1 million write off, which is incredible for me and for my family. And I'm thankful for it. So if it makes sense for you, then it's a no-brainer. And I think I paid like $20,000 or $21,000 for that. Again, being able to write off that as well. So there's many different pieces to the pie here. I wasn't aware of the energy tax credits. I love that. And so I'm excited to be able to implement that within our tax accounting and strategy plan for the future. And anything else that we're missing here, Joe? I'm excited for this.
I should mention just really quickly is that the energy tax credits, and this is going to be for most everybody out there, but it's for a multifamily 4 stories or less and a single family. So keep that in mind. If you have a high-rise multifamily, then the 45L is not going to work. There are other energy tax credits that are available that, that we can go into. So don't think that I can't. But the one that I was talking about, the 2,000 and the 5,000, that's for the residential up to 4 stories.
Yeah, so it's residential multifamily, and so that's a single family up to 4 units. So duplex, triplex, fourplex. So take advantage of
units. That is it's just stories. For some reason, they wrote it as stories. They don't want the multifamily being over 4 stories in height. Yeah,
in height. Okay, but it can still be like residential multifamily, meaning 4 units, right?
Yeah.
Like I have a duplex. We have a fourplex. So
for sure.
I could use. Okay,
and the duplex would be per door. You'd get 2 tax credits for that unit. If you have a quad, you're going to get 4 tax credits.
Yeah. Okay, cool. Well, I love it, Joe. I appreciate you greatly. I think this is tremendous education. I got a ton of notes here myself, just so you know. And I think it's really helpful for a lot of our listeners that aren't necessarily educated on this and need this for their taxes and their future planning. Just think about how much money you can save instead of paying Uncle Sam. Let's just be real and honest. Like as an investor, 9 times out of 10, I can bet that you as that investor can really put the money to work better than Uncle Sam in many cases. So, keep doing what you're doing, keep, not paying all those taxes, doing it legally, ethically, having those write-offs, and then being able to save that so that you can keep growing and scaling your business. I'm a big advocate in this. It's not always about the making money. It starts coming into play when you have a decent amount that, hey, how do we protect this, preserve it, and start really creating generational wealth? So, Joe, how can people get a hold of you, the company, get a free kind of understanding and estimate if it's a right fit for them?
Okay, it's U.S. Tax Advisors Group Incorporated. To make it really easy, just go to USTAGI, www.ustagi.com. And then fill out one of the forms for the estimates. And we want a little bit of building information, like what you paid for it. And again, just so you know, this is all again, I think I mentioned this. This is all again on what you paid for a building. We don't care about the value of the building. I don't
Sure.
care if you bought a building for 100,000 and now it's worth 10 million. That has nothing to do with depreciation or energy tax credits. It's what you paid for the building. So bottom line is you give us a little bit of information. We'll turn around and we'll give you an estimate and we'll give you the fee. And then you can decide whether you want to move forward or not. I advise people to take it to their accountants, talk to them and say, hey, look, this is what Joe says. What do you think? Yes or no? Keep in mind, there's a lot of misconceptions out there. I'm happy to clarify all the misconceptions because there are many.
Yes, that's so good. Well, I love it. I appreciate you greatly for jumping on today. Anything that, me or the listeners could do to give back to you?
No, I think that, maybe you could sell me some real estate.
Yeah. Let's get some. Yeah. So I appreciate you greatly, guys. Reach out to Joe. He's a wealth of knowledge. It can definitely help you in saving some cash on your taxes instead of paying Uncle Sam, doing it legally, ethically, and morally. Yep. And that's what it's about. So Joe, appreciate you greatly. Guys, reach out to Joe. And if you guys want to get a hold of me, you can always do so on Instagram. It is Brandon Elliott Investments. Otherwise, facebook.com/Brandon Elliott Investor. And then if you haven't already, hit that subscribe button to Ready, Set, Go Real Estate Investing Podcast. You get the newest notification every single Monday. Leave that 5-star review. Greatly appreciate all the love, all the support. It means the world to us. And it gives us the energy to keep doing this. And then also, if you are truly looking to get up to $500,000 every 6 months at 0% interest, then check out creditcounselelite.com. That's www.creditcounselelite.com. There's a quick 10-minute video on there to learn more about how we can best serve you, whether it's travel hacking, business credit, personal credit, fixing credit, get to the 800 club within 30 days or less, and so much more. And you can be able to fill out a quick form after watching that video so we can learn more about you and schedule a free 45-minute call with either myself or with one of our team members in Credit Counsel Elite to be able to best serve you and help hit all your goals. So we will see you guys on the next episode of Ready, Set, Go Real Estate Investing. And until next time, guys, stay blessed. Thanks.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.